Hello, it's Peter Locke here, the CEO of Heritage and People's Choice. And I'd just like to take this opportunity to give you an update on how the merger has gone for the first 6 months and to show you and walk through the financial results with our Chief Financial Officer, Paul Williams. So firstly, I'd just like to give an overview of the operating environment and the economic conditions, our financial performance, a little bit about the merger, and a little bit about our community. Firstly, onto the economic conditions. So we've been operating in a very interesting time with rapid interest rate rises coming through, and we haven't seen those obviously for quite some time. And whilst people are a little concerned about the impact those interest rates might have, the big point for us is looking at unemployment, and we're still seeing the unemployment rate as being very low, and consequently our credit quality is holding up. Most borrowers manage the high interest rates pretty well. We are seeing that those savings buffers that came through COVID are starting to be utilised, but overall household balance sheets remain in very good shape, and consequently the strength and credit quality of our book is also in a very strong position. On our financial performance for the year, we're happy to produce a net profit result of 32.1 million. Now Paul Williams will go through a little bit of detail about how that profit was derived, but it's off the back of very strong growth in assets, very strong growth in our deposits, and we have a great capital and liquidity position as well. We are, of course, going through that merger, incurring some additional costs as a result of the merger, but these are all planned, they are all detailed in our pre-merger commitments and as a result of the integration pathway that we are currently on and still going through. When we do look at how the merger's gone, we're only 8 months old. It's been a really smooth transition, but underpinned by a very strong culture. The culture of both organisations, the ex-Heritage and the ex-People's Choice, are very, very closely aligned, and that's been a key point in underpinning the success of the merger to date. We have embarked on what is a multi-year integration plan. That has been approved by the board. That does move us to a pathway of creating one set of systems for the integrated bank, and that's going to be very important to our underpinning strategy of delivering simplicity and elegant solutions for our member base, while still driving competitive and secure banking options. Importantly, through the merger, we haven't taken our eye off the ball, and our business as usual focus and our focus on the member have been underpinning our success. So over that time, we've had strong growth in membership. We've grown strongly our lending and deposit portfolios, all at multiples of systems growth. And of course, we've maintained high levels of customer satisfaction. In fact, the customer satisfaction scores for both brands have actually improved from very high levels. Now, I've mentioned a little bit about our members. That was very strong, with net member growth of 26,774 new members and net new members to the bank over that 8-month period. That's been a very, very strong outcome and really does underpin the value proposition of the merger. I've mentioned a little bit about those customer scores. The Net Promoter Scores at plus 37 for the combined bank is a higher average score than major banks. We're very proud of the Net Promoter Score, the advocacy that our members drive for our proposition, which is of course member-based and for members. Now, members also are an important part of our community support, and being a mutual, we are always focused on giving back and supporting not only our members and our staff, but the communities in which we operate. And that community support for the year came in at 11 $7.08 million directly contributed back to the community by way of grants, by way of support and sponsorships. And we're very proud of that, and that's part of the underpinning structure and strategy of the bank going forward. So that's a little bit about the operating environment. I'm going to pass over now to Paul just to walk through some of our financial highlights for the year.
Thanks, Peter. From a financial perspective, the bank has performed very credibly against the backdrop of the merger process, as well as the highly competitive market conditions in which we've been operating. Profit before tax for the year to 30 June 2023 was $42.8 million and $32.1 million after tax. This amount represents 8 months of standalone PCCU profit plus 4 months of HPC results. Underlying operating profit before tax, which excludes merger costs, was approximately $67 million. Now, this does not include the 8 months of profit earned under the Heritage brand, which was actually booked into contributed equity reserves on the 1st of March 2023. Sustained lending growth pre and post merger was a highlight for the bank. HBC generated $2.194 billion in new loan approvals in the 4 months to 30 June, which is an incredible effort and underlines our continued focus on members even as we bring the two businesses together. The residential loan book on a comparative basis grew 5.2% for the year, which was bang on system growth. Growth over the 4 months since the merger was 8.96% versus system growth over the same period of 5.58%. Consolidated assets increased by approximately $540 million during the year to finish at $23.3 billion. Unpacking the profit numbers is challenging due to the complexities of the acquisition accounting treatments, but some notable highlights include net interest income, which for the consolidated entity was $319 million across FY 22-23. This just shows the value of the pricing decisions that we make as a mutual, which always consider both depositors and borrowers during what is a sustained interest rate rising cycle. The P&L also benefited from the strong credit profile of the portfolio, with impairment expenses well contained. The provision for impairment over gross loans and assets was 0.13% at 30 June, which was slightly lower than the prior year. We expect this metric to increase over the next 12 months as the reclassification of impaired loan categories required under acquisition accounting treatments is gradually normalised. Not unexpectedly, there has been sustained pressure on operating expenses, with total costs impacted by elevated inflation as well as costs associated with the merger-related initiatives. Personnel costs remain a focus for the executive, as do integration expenses, including ongoing changes to technology costs associated with HBC's transition away from legacy systems and onto new platforms. HBC's funding base looks extremely healthy post-merger, with the proportion of high-quality retail deposits approximately 83% of total funding at 30 June 2023. Household balance sheets remain solid as emergency monetary and fiscal settings have been unwound by the government. The strong growth in retail deposits pre and post-merger is another balance sheet highlight, which has helped manage the repayment of $250 million of the RBA's term funding facility during FY 22-23. We've actually repaid another $210 million post-year end. The solid retail deposit growth reflected a preference for customers to shift out of lower yielding transaction style accounts into the high yield savings and term deposit products that we offer. This is an industry-wide trend and drove significant system growth across the sector, which across the year to 30 June 2023 grew by 7.5%. HBC has built notable funding capacity across committed and uncommitted facilities, including 3 securitisation warehouse arrangements. The bank currently retains an elevated liquidity position, which will support repayment of the remaining RBA term funding facility balances. We have approximately $570 million of TFF to repay in calendar year 2024. HBC has prudently retained above average levels of liquidity since the merger and has ambitious plans to build a mutual ADI leading wholesale markets franchise in the years ahead. We'll do this by being a consistent and regular issuer, and we've already engaged wholesale investors across Australia since the merger was effective on the 1st of March. The bank's debut capital market transaction was successfully completed in September 2023. It was a $1 billion RMBS transaction, and it represented an excellent first stake in the ground for our new bank. It was well supported by the market, with a final issue volume materially upsized due to strong domestic fund manager support. My final slide talks to HBC's capital position, which remains well above prudential minimums and will support core business objectives across the short and medium term. The solid profit result underpinned HBC's Tier 1 capital position, and despite the strong growth in the loan portfolio, we maintained very healthy capital levels. The RMBS transaction completed post 30 June means our total capital position is another 50 basis points higher as at the end of September. Sustainable capital management remains a core strategic objective of the bank and will underpin resource allocation decision making across all aspects of the business during the integration process. HBC has a significant integration program to fund over the next few years and expects capital levels to remain broadly consistent during this period. Balancing loan growth objectives whilst executing the integration program, which is a considerable piece of work, will be a focus for executives and the board, and a challenge that the business is well positioned to manage. I'd now like to hand back to Peter. Thank you.
So thanks, Paul. They are really strong financial results, and we're very, very proud to share those with you today. They are underpinning the whole basis of the merger, and we are confident that those results will be replicated and strengthened in the upcoming years. So let me talk a little bit about the financial outlook and how we see the bank progressing. So firstly, as I said in my opening comments, our balance sheet is really well positioned to support our future growth. We've got a strong credit quality. There has been absolutely no change to our credit risk appetite as we've gone through the merger, and we will maintain that balanced approach to make sure that we've got a really strong and quality portfolio that gives strong returns and good growth. You know, the rising interest rates, we don't think that we've necessarily seen the end of those yet, but they have yet to impact credit performance. Now, we're cautious about that. As I mentioned, we've got our eye on unemployment, but whilst the unemployment figures are low, we believe the credit quality and the strength of our members meeting their commitments will continue. The focus that we have on our member remains strong, but we've got to have a balance in that. Most of our members are actually depositors rather than borrowers, so that we have to make those interest rate decisions with that balance in mind and making sure that we've got that constant dividend of mutuality coming through in competitive rates and fees, both for our lenders and our depositors. As we go through next year and the upcoming years, we have a heavy integration program in front of us, and that does come with additional costs. Now, these have all been factored in to our forecast, factored in to the strategy around the merger, and we're in those merger implementation documents that we put to our members for votes. But we have to keep a very careful eye on costs, and we've got a very stringent program management strategy and discipline around how we are going to go around those integration issues. So our strategy going forward, we believe that we have made a strong start on our mission to be that authentic alternate to the majors, that creation of a national mutual brand that hasn't really been in the market ever. So we are bringing a new brand, a single brand to market. We are confident that we are going to be able to announce that in the next few months. Our prioritisation of merger integration activities, as I said, will dominate the landscape for the next couple of years, but we have a very disciplined approach about how we're going to deliver that. It underpins our strategy because it is a strategy based around single system, simplicity and scalability. And we believe when we deliver that the merger benefits that we've spoken about will be created and delivered, and that underpins that long-term investment. Now, our growth expectations for future years reflect the economic conditions. We do have intentions for systems growth in the short to medium term. That does always revolve around the importance of member growth and delivering to members a safe, secure, competitive and importantly a contemporary banking solution. Underpinning that, of course, is our desire to do good and to continue to deliver on our ESG promises. We have a diverse range of initiatives to do that, and we will continue to support our people, our members and our communities going forward. In short, we think the future is very, very strong for us, very positive, as we bring a new single brand to market based around a very contemporary and competitive technology stack that we're putting into the bank. We believe that our members will benefit and we'll be excited to see a new national alternate being brought to the market. So thanks for paying attention. Thanks for Paul for his presentation, and I look forward to keeping you abreast of all of the changes and initiatives that our bank will bring to you in the future. Thank you.